5% and remains below 5%. So essentially, while it affected throughout the year, as at the reporting date, we see inflation not really being a major issue. But during the year, because as most of you know, the big number there was food inflation. It meant it removed the disposable income from the family. So when you look at savings, savings will be impaired significantly by the fact that people had to spend what ordinarily they would be saving to meet food requirement, because that was what was driving, say, 102. So for purposes of reviewing performance, we could say we experienced a stable exchange rate throughout the year, or the exchange rate fluctuated within a minimal range. So it was really a very stabilizing factor. When we look beneath that curve, we see what really drove that stability had a lot to do with foreign exchange reserves. And we see the reserves were throughout the year above, next slide, Anthony, were above the minimum import, months of import requirement or cover. So essentially, that explains the stability. But we see a trend when it comes to crude oil prices, and we see a gradual rise, and eventually by September we see a sharp rise in oil prices, rising all the way from 40 to 60 dollars per barrel, and essentially when you talk over 50%, and to a great extent 100. If you look at the very beginning of the year, we were at around $30 per barrel, and it ends up at 60. So prices of crude oil has really doubled during that period. And the country has shown resilience. Yes, there is pressure on the reserves, but the country reflected a lot of resilience. And we'll talk about what really was behind this resilience, given that we know our oil import bill constitutes almost 25% of all our import bill. So you could see that is likely eventually to have significant change. But as I say, the biggest driver for that resilience looks at diaspora remittances. So as prices of oil increased, we saw the remittances flow from the diaspora were increasing, not almost at the same level, but steadily. And so this coupled with significant also inflows from tourism, as we shall see, then kept the reserves steady. Yes, the cost of crude oil is rising, but the inflows from remittances were rising also significantly. But there was also another dimension, that the private sector credit growth was at its worst over a period of 2 years. We have climbed from a growth rate of nearly 22% private sector credit growth to 2%, and that really explains that declining growth rate might be a very big factor, reducing demand for foreign currency. So on one hand, there is significant flow from diaspora, and on the other hand, there is a significant decline of need for capital. And that, if you jump to slide number 8, the next one, we also see that tourism sector also was really significant in terms of flows. So when you combine this, and again, this slide really demonstrates how the economy is becoming resilient even during political times. It's only in August when we first held the elections, and October when the presidential elections were nullified, that we see the numbers of tourists coming into the country affected. But we can see the quick recovery. We have not seen 106,000 tourists in a month like we saw in December. So essentially, we are seeing significant resilience in the economy. And if this trend then continues, then we could project that we're likely to experience stable exchange rates and currency. Going one slide back, we see the total effect on the current account position, and we see the pressure that importation of food had on the exchange rate. Maybe we're talking about 23-30 billion shillings of food imports, and we can see the impact it had. It had not been fully budgeted for, and consequently ended up increasing the deficit from 5.2 to 6.2 on the current account. So essentially, is that too heavy to cause concern? Then one would say just increasing from 5 to 6, having been at 10 in 2014, means that maybe the economy is becoming large in size to be able to observe. So one would expect deposit growth rate would be very slow because consumption is very high of whatever is available to meet the food prices, the unexpected food prices. We see stability in currency, but we understand the underlying factors seems to suggest that will hold. And then we say, well, those are the prices. What about generally the operating environment within which those prices were operating? And we see essentially drought was a major problem. Maybe one slide back. Drought was a major challenge for 2 consecutive years. The country had not had sufficient rains, and consequently, that's why we were having problems of food. For a whole year, economic activities were suppressed by political expedience. The country was in a political mood, elections almost starting from March all the way to December, and flowing into this year. It was a heavy electioneering year, and that took a lot of weed from the sale. So the environment was really what one would describe as turbulent. Neither was the global environment any better. US has not yet stabilized. Europe has not found its ground yet, and China was on a recovery path. So the whole year was very, very challenging. But it is important to then compare with what we are seeing, looking to 2018. Yes, there will be challenges that are already pronounced. The next slide, we see instability in South Sudan. We thought by now South Sudan would have been able to resolve its challenges, but they still remain. We know DRC, we have significant operations. There's challenges with elections. So those are the 2 major challenges that one can talk about, given the predicted stable microeconomic environment. But in spite of that, then when you look at generally, the environment is changing. Well, we see stable prices or economic prices, but also the environment seems to be changing. For Kenya, the lifting of travel sanctions by the US, followed by the other countries, shows now we can sustain the growth in the tourism sector. And tourism is likely to be a major player this year and contributing significantly. I think the opening of direct flights to US from Kenya One, will most likely increase significantly tourism flow. Two, it's likely to open new markets for our cut flowers, for our fruits, and vegetables. So we are likely to see significant improvement also in the agricultural sector, and chances Nairobi will become a significant travel hub or logistic hub because the tourists coming from America then will need to be distributed within the continent. I think great hopes on the economy comes from IMF-sponsored economic reforms that have been tied to the Start by Arrangement facility, and this includes reducing the fiscal deficit from 5.2, hopefully targeting eventually 3. That's a very, very good trade. Government keeping within its means. And more importantly, for us in the banking industry, is the reforms affecting interest capping. And the impression given is that interest capping will have been dealt with by September, because the agreement they have is that all these reforms will be executed within 6 months. So that lifting will have significant implication on the banking industry, and hopefully we can go back to the days where the financial sector could make a significant contribution, and hopefully we'll go back to 20–25% growth rate in the private sector lending. It's notable that outside the DLC, there will be no country holding elections, so we expect political tranquility during this period. A very interesting phenomenon that has happened in Kenya is the coming together of Kenyans, and particularly the opposition and the ruling party, and saying let's focus more on the nation as opposed to politics. That may sound just a statement, but we all know that when our ruling party and our opposition come together, it always brings in significant energy in the economy, and we always witness exponential growth within the economy. And we expect that this will be no different, most likely to have even bigger implications. So we are counting that reduced political risk in Kenya, and particularly if the 8 agenda issue focus is dealt with. It will be, as we all know, the issue of reducing tension within the country, the issue of focusing on inclusivity, all those issues of electoral reforms. If all of them are addressed effectively, then Kenya would be on a very steady path. I think more importantly, given that Kenya and the region are agricultural economies, with more than 25% of the GDP being on agriculture, or coming from agriculture. The early lanes in March, long lanes have come 1 month in advance and have sustained and held and have been received throughout the country. We expect significant recovery of the agricultural sector, and agricultural sector is a big factor in GDP growth rate. It's not just agriculture, but we are likely to see the crippling effect on water and energy supplies also lifting. And again, if we get energy prices back, inflation will have also been addressed significantly. If we see water supply restored, particularly in our urban centers, again, inflation will be addressed significantly. And as we have said, that there is significant hope that forex streams from diaspora and tourism flows will continue to grow and grow significantly. I think it's also worthwhile for us, particularly at Equity Bank, to say the focus on the big four, the president's legacy agenda of the big four banking business is on small and medium enterprises. So medium enterprises will really become the biggest beneficiaries of our manufacturing industrial focus in the sense that they will populate the value chains of those enterprises. So we see that as a huge opportunity. But going beyond East Africa, I think what we witnessed yesterday that relates to Africa Agenda 2063 holds a great opportunity for the continent's transformation. And given that we are operating in 6 countries already, with an ambition to be in 15 countries within the next 10 years, it really means that this opportunity is likely to lift equity significantly. The signing yesterday of the African Continental Free Trade Area with free movement of persons, supported by the African Open Skies space, and focus on accelerated industrialization and joint development of infrastructure, cross-border loads, railways, energy pools, strategy, and communication is likely to change the operating environment and create significant opportunities for those in business or facilitators of business. I think more importantly is if the cross-border trade increases from 18% to what is being targeted to about 60% by 2030, then it means trade finance in Africa will become a huge opportunity. If there is a possibility of convertibility of currencies between the African countries, then that would almost exclude international banks, and that would really be a huge transformative step for the African financial system. But also significant will be the focus on natural resources, mining and processing of the same within the continent. The value addition that would come with manufacturing and mining, again, would really transform the economies in Africa. And of course, that would then all move through the... So we are starting 2018 very confident and very bullish that what held us back in 2017 is behind us. Drought is behind us. Power rationing is behind us. Water supply is behind us. Exchange rate and inflation is behind us. So we are very, very optimistic. The only thing that we are hoping and looking forward that it will be enacted sooner than later is the interest rate capping law. If that's removed, then we would expect very, very good results. Having said that, we want to reflect that given the situation we were in, the big elephant in the room was interest capping. But we took it that interest capping was a new norm. And we said what we needed to do was to play on the business model and strategy and shape leadership to operate as if this is the new norm. So for us, removal of interest capping will be a big bonus. But we had modeled the bank to focus on that. And basically what we will be looking at, the results of 2017 have been shaped by 3 factors. One, decisive leadership, a very strong leadership. We have never been put to test like we were put, in the sense that we took it that interest capping regime will be the norm. So the question was, how do you, as leadership, provide leadership in such an environment? How do you create a business model that would survive, become sustainable under such a model? And then what strategy will you execute? And what would be the speed of execution? Because results are reflected within a financial year. So it was a question of leadership to be decisive, very strong in execution, develop appropriate strategy for the environment, and lastly, ensure the strategy builds a new business model. And within those three thought processes, Equity came out with a new business model and a strategic intent that tampered with the critical success factors of the bank and created a new model founded on 7 thematic areas. The first one was to recognize that interest income no longer reflected quality earnings because the capping was at a low level, NPLs were at a high level, so there was always the risk of non-performing debts eroding any gains that anybody made on interest income. So we decided to focus on non-funded income as a major driver of the bank. And that was really shifting the model. And of course, we are talking about becoming a major transaction processor, a major that became. And to lead, we then said, if it is very challenging to lead to the private sector, and we have seen the decline of growth rate of lending to the private sector, then it was appropriate for us to look at Treasury as a new engine. And Treasury was significantly revamped, as we shall see. And Treasury had 2 aspects of it, public debt and Forex. And Forex has 2 aspects to it, fixed income, and of course that is public debt. And then there is Forex, sales and interbank. That really became a tool. And I want to recognize the great work that we were led to do by James Motuko. Maybe James, you could wave. Is Gashawin, the treasurer for Kenya? Daniel? Those 2 led the whole bank to really focus. Then was really focus on subsidiaries. And we said, yes, the subsidiaries in DRC, in Rwanda, in Uganda, in South Sudan, in Tanzania, the telecom, FinServ, insurance agency, brokerage, had not been affected by interest capping. And we said, can we really move more on regional focus? And if there is lending, let's strengthen the lending engines in the subsidiaries and do diversification. I want to really acknowledge the effort of our managing directors of the subsidiaries. And maybe if we could start with Uganda. Samuel, you could wave. Managing Director of Equity Bank Uganda. Addis, Managing Director of South Sudan. Of course, we are very lucky to have Celestian, Managing Director of Congo DRC, Managing Director Tanzania, Joseph. Okay, Proges, and Managing Director for Rwanda, Huntington. They really put their best foot forward, and we'll see how well they played to make equity really needed to be done. And of course, then there was a strategy team led by Mary, Brent, and James Motuko that looked at strengthening our liquidity and balance sheet agility. We felt the turbulence within the banking industry and with the economy required a different structure of balance sheet. And we'll see again how it was restructured during the year to make it fairly liquid and defensive. We took a defensive position, but also a position that we could be able to absorb shocks, but with the appropriate agility that, particularly with interest capping, we could easily deploy funds in a very swift way. And of course, then there was a team that said the focus on credit would be on quality of the loan book. I want to really recognize the team led by Elizabeth, the Director of Credit, Moses, corporate leading. Where is the other team on credit? Dungu and Michael. That team there led us into what we call the digital lending. And essentially, I was very impressed that at the end of the year, they lent out 94% of all the loans that we processed were processed by digital channels and constituted about 27% of all the lending during the year was led through that channel. But more importantly was quality, and we'll see the law enhancement of quality. We take a lot of pride of that team because they have differentiated themselves from the rest of the banking industry in terms of quality of loans. And of course, there was a very significant effort in pushing innovation led by Batesh maybe. He led our digitization and led the innovation team that included Karobi Eric. Karobi Eric headed that team. We had Jack again, Festus, John Wamai. That team did very well in ensuring that, and of course there was a team, our finance team led by Anthony and Sammy. Anthony and Sammy are very good. The men at the very back, it's their numbers. They focused on efficiency, and we shall see the role efficiency played. So if we now go straight, just one or two slides in what each team did, we see loan interest income growth. We lost 21% of all our interest income. If you look, we moved from 43 billion to 34 billion shillings. We lost 9 billion shillings in terms of interest income because of the interest capping. But as we can see, the Treasury team put their foot forward, and they recovered 5.5 billion shillings. Out of the 10 billion, 5.5 billion was recovered. And eventually, if you could see, when it comes to total interest income, the decline was not what was had been projected by the credit team, that they could lose 10 billion. They ended up losing only 4 billion shillings in terms of total interest income. So 6 billion shillings was recovered by Treasury. And that responsiveness was very, very good. And then, of course, then we said non-funded income came in very hardy, and again recovered significantly 5 billion. Where did this non-funded income come from? It came from across the board. Every department did put their best foot forward. We can see Forex 15% up, salaries processing 11 up, gross merchant commission 16 up, mobile banking commission 64% up, diaspora remittances that 1% up, American Express 54% up, agency commission 15, and trade finance 16. So we saw this as very sustainable. It was not a once-off, so we can assume that the model from that perspective was fairly sustainable. And we saw particularly the remittances and processing. We had merchant banking also going up by 16%. Merchant banking is the next slide, Anthony. Please move with me so that we are really moving together. So essentially, those are the main lines of non-funded income that went up. But if we did a deep dive on Treasury, we'll see that the big thing is Treasury was allocated an additional 28 billion shillings during the year. They had opened the year with 100 billion shillings public debt. They ended up with 128. But that is not where the miracle was. The miracle was increasing yields on that 128 billion from 11% to nearly 12%, 100 basis points. That was very significant. So when you are reducing interest on loans, we were increasing the effective yields on the Treasury boards. And as we can see, Treasury ended up increasing its contribution of total income from 16% to 25%. So credit department and others moved down from contributing 84% down to 75%, and Treasury increased their contribution from 16 to 25%. And as we can see, for Treasury, it was a hard job. As we can see, the forex income, the board trading, and placements all went up significantly. So that's how they won the battle of deflating the effect of interest capping. And we shall see eventually they helped the bank to defy the impact of. When we talked about subsidiaries, this was the most interesting, and as we can see, the contribution of profitability. We look at Uganda, it increased its profitability after tax by 7%, DRC by 60%, Rwanda by 7%, Tanzania by 18%, even South Sudan, which we said we had brought to maintenance level, improved its performance by 113%, and FinServ 21%, and insurance by 94%. And essentially what happened is the contribution of the subsidiaries moved from 7% of the total profit to 14%. And we can see that contribution changed the equation for us. So we can see the role of diversification, removing sovereign risks, particularly with policy changes, ad hoc policy changes, and of course different lines of business. And these again, questions had been asked before, and we can see the subsidiaries are now growing to size, and we expect this year they will be able to punch even more and more above their weight. And we are looking forward to seeing them contribute between 20 and 25% of the gross profit for the group. Now, as we said, to mitigate the economic uncertainty and shocks, we needed a very agile balance sheet. We thought liquidity was a great weapon. As they say, cash is king, and preparedness in case of change. And as we saw, this liquidity came in with a reward of a 1% percentage point increase, or 100 basis point increase in returns. And this is what we would say made the bank very defensive. It could fed in a very, very challenging environment, but the bank had the tools and the weapons to defend itself. And now it's ready to redeploy all that funding within a very short period. And we can see how that is spread out in the balance sheet. We look at the funding. Deposits continue to be 41%. Shareholders increased their contribution to 18%. And we sustained borrowed funds because they are long-term. And the only effect we saw was a substitution between government securities, cash equivalents, and lending. And as I said, and this will really explain what most people refuses to accept as a reality, that the big challenge the country went through with interest capping was cap interest rate at a rate equal to sovereign risk rate. And that is purely the public sector crowded out the private sector. But equity pushed its best foot forward, and we see NPLs declining from where we had started with 6.8 to 6.3. And I'm very, very proud of the credit team, because when you look at the sector was at 10.6. So we were 400 basis points lower than the banking industry. And that again demonstrates that we have no legacy issues to deal with. You lift the interest capping, the bank is ready. It doesn't say, if you look as at February, if I'm not mistaken, NPLs has gone all the way to 12%. And I believe the quarter is coming to an end. The bank maintained a very conservative approach, as we can see. It increased its coverage and it increased its provision. Even though the NPLs were coming down, we saw coverage being increased significantly just to make the bank resilient. So we maintained the same conservative approach that we had. And of course, we will see the impact of efficiency, and the efficiency came mainly from innovation and digitization, where we talked about the team. And we see now the bulk of the bank is on digital platforms. The customers are serving themselves on self-service platforms. Third parties have come in. And as we can see, the power of Equitel. We have always said Equitel is not a telecom. Equitel is infrastructure for banking services. As we can see now, it has taken over. It is processing the highest number of transactions. As we saw last year, it processed 251.6 million transactions. And the nearest to that was the mobile app that was launched during the same year, which processed 92.8 million transactions, followed by agency that processed 62.2 million. But look at how it compares with the branches. Branches only processed 18 million transactions. But the most important thing to note is when it comes to the value of transactions. The number of transactions have moved out of the branches. But as we envisaged from strategy, our branches have now become SME relationship management. And the volume of cash handled in the branches remained the same or increased slightly by 1%. So really the transformation of branches to SME bank or enterprises, the transformation of branches to high net worth and corporate banking outfits is complete. And this answers the question that people kept on asking. If you virtualize the bank, as we have seen, what will happen to your staff? The staff were just retrained to be Salesforce relationship managers, and that is why there was no retrenchment. We were moving transaction banking and converting what was previously transaction processing branches into relationship, SME, corporate banks, and we shall see the effect of all these. So this is a very good picture for us. And the shared prosperity concept, where you have merchants and agents processing the bulk of the business beyond the self-service platform. Third parties are now playing. I think that picture becomes more clearer if we put it in a pie chart. So let's look at how it looks as at pie chart. At pie chart level, Equitel processed 54% of all transactions, followed by the mobile app, Easy app 20%. So you can call it 75% of all our transactions now are self-service. And another 16% by agents and merchants. And you can see branches are only dealing with 4% of all transactions. A huge transformation. And if you compare that between 16 and 17, the picture becomes clear of how much effort Batesh and his team put through to ensure the customers keep on migrating. This defines the future of Equity Bank. And as we said, transaction banking have moved. Banking is no longer where you go, it's what you do on your phone. As we can see, this year we shall see another big phenomenon called EasyBiz. EasyBiz is Equitel or EasyApp, but now for the business customers, large businesses. We have given them a cash and liquidity management capability, and they will no longer need to come to the bank. They can pay their employees, they can pay their creditors, they can receive, and they can do all the postings automatically. And we are seeing a significant peak. Is Akin, very good. She's the head of that division, and last year, most promising banker. We will see her this year maybe taking 10% of all transactions. So the businesses also start moving away from the branches, and the branches now are no longer handling just SMEs, but they become truly relationship and sales force. And then maybe we are set for great growth. Another very significant innovation was on diaspora remittances. And as we can see, we received an increase of 132%. We saw commissions went up by 64%, but you can see 30 billion shillings was handled by the bank, up from 13 billion shillings. And the bank is now becoming dominant in that space. This year, our projection is that we'll do in excess of 8 billion shillings whole year. So again, we'll see the capabilities of innovation, the capability of digitization. And this again continues to speak to a better quality stream of income from fees and commissions. Then Equitel kept pushed a little bit back from 25 to 19% of value. We believe we don't allow betting on Equitel. We think it's not a light catcher to encourage. We think we lost ground because of betting, but we believe that is the right decision, not to allow betting on Equitel, and we'll stick to that. And of course, Equitel is not very popular when in the electioneering period because it is mapped to a bank account. So politicians don't use it during electioneering. So that tells you why we lost the ground, but we are back on the slide. But because of ethics, we will not take the shortcuts to allow things that we really don't. Our innovation on agency has continued to play well. These mirrors our shared prosperity beliefs. And as you can see now, we have 30,000 agents in a single month receiving on our behalf cash deposits of up to 36 billion shillings and paying 15 billion shillings on withdrawals. And it really excites me to see them sharing 5 million shillings every day in terms of commissions for these. Now, the sum total of all this is efficiency and cost optimization. And as we can see, the bank was able to defy any cost growth. We ended up with almost zero growth rate in terms of other expenses. negative growth on staff cost, and that essentially helped us to almost maintain cost-income ratio despite losing the 4 billion shillings on top line of income. Despite losing that income because of interest capping, losing 10 billion shillings, cost-income ratio didn't change significantly because we managed to contain costs and the cost-income ratio. When you look at contribution, we see that the contribution didn't come from the top line. It came from the bottom line in terms of cost, because we were able to maintain our yields at 11.2 and maintain our cost of funds at 2.7 and maintain an interest margin of 8.5. More importantly was the resolve that we should focus more on shared prosperity, and we looked of a business that would have impact in community. And we continued to do better. Almost 1.6 million Kenyans have now been trained on financial literacy. We have 25,000 who have been trained on 36,000 trained on entrepreneurship, and we now have 10,000, almost 11,000 kids in our universities, 15,000 wings to fly, and 443 scholars out on our airlift program, all at a cost of $228 million, or 23 billion Kenya shillings. And we're very, very proud of that contribution of lifting. Now, that is what we did. That's what we thought the strategy would mean. That's what all our energy was, and that's what we thought the business model would look like, and an interest capping regime. I want to take you slightly through what others thought about it when others looked at us. I know you have already formed your opinion about us, but I want to share a few public opinions that others had. And the first one is Moody's. Moody's said, yeah, this model really compares differently and differentiates equity more from other banks, their peers, who are more aggressive on loan growth despite the challenging environment. So what they said is that the management was prudent. They didn't fly into a storm. They avoided the storm. And of course, then they went on to say what then comes out of this. And we can see the social impact. They said, well, the brand is now heavily recognized, solid liquidity buffers and resilient funding profile, an established domestic franchise, and an extensive adoption of digital and of alternative distribution channels. And then when asked then what is equity's credit risk, they gave equity the same rating as the Kenya government and one notch higher than any other bank in Kenya. So we are rated one grade higher than any other bank in Kenya. And of course, that was soundly repeated by Global Credit Rating also. It's almost word for word. And again, we felt very strong that in a very difficult year, we could maintain our credit rating. Our performance kept on improving, and 2017, we were rated the 37th most solid bank on earth. And despite the challenges, our returns were still high. Euromoney still thought we were the best bank in Africa, the best SME bank, Anthony, the next slide, in Africa, and Kenya's best bank. And I was glad I joined Gaki, who was voted the best young banker in Kenya. Was also named the Kenyan banker and CEO of the year. And we went on with a lot of awards. It pleases us. We entered 24 categories. And as we can see, we won almost all of them. And we retained our superbrand status throughout the year. A feat that we have held for the last 10 years. And customers, it's all about customers. And as we can see, in terms of preferential, we hold the highest preference any bank enjoys in Africa at a national level, with 40% of all Kenyans saying they would prefer. But this can be said by surface. Customers vote with their feet. And this is what excites us, that even in a difficult year, we still added 1 million customers to the Equity Bank base. And that growth consistently. And for me, if you look, 2012 to 2013, we added about 600 customers. The following year, we added 1 million, but we have sustained 1 million from 2016, still another 1 million 2017, and we hope 2018 will even exceed there. So market is very important. What the customer says about you is what is very important, because essentially this is the customer who allows the bank to do intermediation and intermediating. These are not what you could call wallet mobile customers. The mobile concept in equity is of a channel. We compare our mobile channel, Equitel and app, as ATMs. They are just the channels. There is no customer that we call a mobile customer. So we are very different from the partnership with telecoms, where you double count customers with a telecom. These are people who have opened bank accounts and then connected their phones to the account as a channel of service. Not saying you are being brought by a telecom customers and you serve telecom customers and you regard them as your customers. The next day you hear them moved to another bank because they are customers of a telecom. These are Equity Bank customers. But customers can also vote, but market is the most important. And we are very excited that the market seems to have given our strategy a little big vote. The bank has now hit a market cap of 200 billion Kenya shillings, nearly 50 billion shillings, bigger than the second largest bank in the country. That is not a small feat. And I want to really congratulate my management for this feast. The people who have gained most out of very decisive leadership, very appropriate strategy, and business model are the shareholders. This year, I think we are up almost 40%, if not more, in just 2.5 months. So market seems to have agreed with the strategy. And this gives us confidence that all that we need to do is to accelerate the And sometimes it's very important not to compare yourselves with the peers. Remember, last year, the second quarter, there was a lot of questions. James, you are doing this while everybody else is doing this. You don't have to follow the pack. You can choose to be a market leader. And eventually, the customers have voted that this is the best strategy. The market have said, this strategy, we are willing to pay a premium. It has a value, and hopefully. But let's look at the numbers. Numbers never lie. All the others are narratives and stories. And what we see, total assets grow up by 11%. Despite the 12% inflation that we experienced during the year, customer deposit still went up by 11%. And for us, despite conservative lending our loan book still grew by 5%. It's not that we pulled out of lending, it's that we were conservative in terms of lending. And if we really look at that lending, the reason why we were conservative, I don't know whether, Anthony, you can go back to the slide showing NPLs. The slide showing NPLs. Yeah, that one. If you look, the reason why Equity had a challenge with lending is because of micro enterprises. That's our bedrock. Gekoba, Kariobangi. That's where our customer is. But look at their NPLs. They're at 15.4. But the lending rates are 14. And I also dare say, from 20th of this month, the highest lending rate in the bank is 13.5 for old and new customers. Everybody is now enjoying 13. But you are charging 13.5 when NPLs are 15.4. That is the risk of that category. And that is where the challenge is, because you can't lend there unless you want to be insolvent. So what happened? Interest capping didn't improve the fate of those people. It excluded them from banking. It excluded them from being, and that is why this cap need to have been removed yesterday, because we excluded Kenyans from participating in the financial sector. Why? Because their risk is high. But they make their profits are much higher than multinationals. So they're able to pay 16%. That category, we were charging them for 16%. We were not making money on them. They were just covering their risk. But they were graduating to be SMEs. And when they became SMEs, their risk dropped to 6%. So 13.5 is good enough. That is what this capping is all about. It never capped interest rate. It capped Kenyans who could get loans. That's what it simply meant. And I'm very emotional about this, because we had made very good progress as a country. We became very inclusive. We became an inclusive country, and suddenly some people got it wrong and decided to exclude 80% of the population from borrowing. And banks are blamed, but unless I want to close the bank, you can't lend at 13 when the risk is 16. Is there anybody here who feels they can? I would be willing to exchange positions. And we see how long the bank could last. Let's go back to the numbers. I wish my friends in the fourth estate could really take this war of exclusion and really help us to liberate Kenyans from the hold and struggle of exclusion. So essentially, what did we see? We maintain that the shareholders, it's a very balanced, and this was what I was saying, a balance. Look at that balance sheet, how agile that balance sheet is, how liquid that balance sheet is. If you put cash and government securities, because that is cash, you're talking you have 210 billion shillings ready to be unleashed to the marketplace. 200 billion shillings. Equity can finance the oil pipeline from that balance sheet. And we don't have to wait for 2022 for oil to flow. And we don't have to take oil using trucks. That is how liquid the balance sheet is. All that 80% Kenyans excluded can share that 200 billion shillings. And they realize their dreams, and we increase the economic activities in the country. That is what, but let's look at eventually what the men and women in the bank helped achieve. And this is what's really the differentiated leadership, the differentiated business model, and the differentiated strategy differentiated itself by a return of a growth of 14% on profit. Here, but I don't know whether there is any bank that has reflected any growth on profitability. Equity reflected growth. It's not that it was not affected. As we can see, interest income was down 4%. Interest expense, like any other bank, was up 8%. So net interest income was down 10%. But non-funded income was up 24%, fully mitigating the adverse effect on total income, and we had a 2% growth rate on total income, despite a 10% decline in interest income. And of course, as we saw, the quality of the loan book, because of focusing on quality, we differentiated ourselves from the banking industry, and instead of increased provisions, we saw declining provisions, despite coverage going up. And of course, efficiency, again, as we saw in digitization, other operating expenses, and so total costs were down 2%. Another major differentiator of innovation. So, and eventually, profit after tax increased from 16.6 billion to 18.9 or 19 billion, a growth of 14%. And for that reason, the management and the board recommends maintaining the dividend payout as the previous year, despite the very challenging year. The shareholders will still have another year that they can look forward to very good returns. When you look at ratios, because yield on loans, as we saw, moved down from 16 to 12%. Yields on interest-earning assets increased from 11 to 11.5. Cost of deposits came down because of capping. Cost of funds came down because of capping. Net interest margin came down significantly from 11 to 8.5. Cost-income ratio, as we said, with provisions almost remained the same. Without provisions, slightly up by 300 basis points. But we see return on equity increased marginally from 21.5 to 21.6, a major differentiator. And the same applies to return on assets, up from 3.7 to 3.8. And dividend payout, as we can see, while we paid the same amount of dividend, payout ratio has declined a little bit from 45.6 to the standard provided by dividend policy at 40, and dividend to par, because the par value of our share is just 50 cents. So it means we are paying 400% on par value. And cost of risk, as we said, declined to 1.6. Loan-to-deposit ratio declined a bit. And core capital to risk-weighted asset increased from 18.7 to 19.7. Let me stop there because I know there is a question coming about the effect of IFRS. And we have simulated and we'll be taking the impact as at 1st of January, and it will only reduce the core capital to risk-weighted asset by 100 basis points from 19.7 to 18.7. So the buffers, remember the minimum ratio required is 14.5, and that the bank, and it's that buffer that made the board consider, instead of increasing dividend, let's ensure that the IFRS is complied with. So Equity Bank will not require the accommodation by the central bank that was proposed of 5 years. From day one, after taking the impact into our balance sheet, we'll still be able to have our ratio of core capital to risk weighted at 18.7 as opposed to the minimum of 14.5. What does that mean? We don't only have an operating buffer, but we have a buffer to accommodate growth and to accommodate investments that the group may continue to make without going back to investors. The investors don't really need to worry. And liquidity, as we said, has increased from 47 to 54, again, showing how defensive the bank was during that period, and with interest capping, how ready the bank is and how agile the bank is to go back into lending. This then brings into question what will be our outlook for 2018. And we're very optimistic that if we could grow a loan book at 5% during interest capping, we should comfortably and easily be able to increase our loan growth book all the way to 15%. But where we shall land, we have given a big range because we don't know when the interest capping will be. But the day interest capping is removed, all micro businesses, small businesses in Kenya will have the funds flowing back because we have 210 billion shillings available for that purpose. Deposit growth, inflation is down. We're able to do 11%. We are confident we'll be able to grow all the way to 15%. Net interest margin, we're saying if there is no interest capping remain, we have stabilized at 8.5. If interest capping is removed, we will not go back to where we used to be, 11, but we can see ourselves going midway to approximately 10%. Non-funded income mix, we managed to achieve 42 all the way from 35. We're very optimistic we'll be able to edge up and have 45% of our income as realized income without anything growing on that. And that is the quality of streams of income that this bank will have going forward. In terms of cost-income ratio, we came down to 53.5. We're very confident we'll be able to hopefully go below 50%, heading to 48. But interest coming, if it's not removed, then we'll still be below 53, a maximum of 52. Return on equity, we expect to move all the way to 25%, depending on timing, and return on asset to go back, tending towards 4.5. And cost of risk, we're very confident we learned everything we needed to learn about how to manage loans. As we can see, we're now operating at half the NPL ratios of the banking sector. We are confident to have cost-income ratio of as low as, cost of risk of as low as 0.8. And NPLs, we are confident we'll be able to reduce them from 6 to a range of 4 to 5.5. And subsidiaries, who we have consulted with our managing directors, we increase their contribution from 14% to 20 to 25% of the profit. And in terms of asset, they will increase their total asset holding from 24 to between 25 and 30%. So basically that is our outlook. 2018 is promising to be a much better year, much better year than 2017 by far. And we can see already from the early results of the year that, it is easing. And if interest capping is removed, then banking will be really good to drive the economy of East Africa, and specifically Kenya. I think I would go much on the appendix, but if you go 2 slides down, There is an appendix that will give you contribution of each subsidiary. You can keep on following each subsidiary and how they are performing. But broadly, that is a presentation on behalf of the management of the results they achieved during the year, a year that fully differentiated them in terms of their competence, strategic capability, or strategizing capability, and more importantly, evolving business model to meet the environment which they were operating in. I don't know whether any of them want to. Brent, anything you want to add? Okay, Mary? Very good. Batesh? Very good. Any of James?